Yeah. I owe that, primarily. We will do that, sir, when we discuss the topic. Got it. So we are working on the MFD material. Hopefully, I think it should be ready by tomorrow or day after max. This will give you, I think, what is there in to study MFD part. We are, as I keep saying, we are living, breathing. That's our each and every day. Second. Yes. Okay. Please put yourself in mute.
Sir, this is for SIF exam, sir.
Someone has put yourself on the mute. Yes, sir. This is SF exam now. Is it your first class? Is this your first class or what?
Yes, sir. Yes, sir. First class.
Where are you joining from, sir?
Joining from Bangalore, sir.
I don't know how much you will be able to understand. It's a first class there, but as I mentioned, I think we are looking to do an offline session in Bangalore this week. Hopefully, I should be able to get the dates by tomorrow. Once that is there, please come and join. But you can be part of the session there anyways. Okay, guys, let's get started. Again, we'll take it slow, as we go along, like what we did yesterday. Get into the full screen mode. Yeah, if you want, start attempting that, yeah, start attempting this one. As per the rules, what are the allowed? See, interest rate is little tricky. There will be a bunch of topics which we have to see. Equity and not tricky there, but like options and futures, we have done that multiple times. Forwards and futures. Interest rate we haven't revised much, to be frank, right? But we will revise a couple of the questions that will come through, in the exam. Okay. So yeah, go ahead. As per the rules, what are the allowed maturity durations of the GBI bonds that can be the basis for exchange traded, cash settled interest rate futures? That's my sorry. Okay. Yeah, go ahead, guys. Okay. Perfect. The answer is, C. The maturity durations actually are 6, 10, and 13 years. It's standard, straightforward question. So the government of India bonds, the duration is 6, 10, and 13. Okay, we talk about 10-year GSEC, 6-year GSEC, and no, it was correct actually. So whenever you have in doubt, right, so always remember. So for example, this is what we do even in fixed income and arbitrage products also, right? Generally, whenever we talk about treasury bills, we talk about T91. Whenever we talk about G6, we talk about generally 10-year G6, right? So even if you don't know the answer, I'm just telling you that. How to eliminate, 259, remove that because, 10-year G6 is where the standard one is. What is B? 3, 7, 12, there is no 10, remove that, eliminate that. Out of C and D, 6, 10, and 13, and 2, 7, and 13, okay? Generally, G6 are of little bit of a longer duration. Okay, so always remember that because it's a very simple concept. It's not that government, uh, for example, right, government doesn't want to just raise the bonds and then wanted to start paying off within 2 years. What happens, the balance of payments gets, I won't say balance of payments, but like you need to work on multiple equations, fiscal deficit, and all the equations that the government gets, right? So ideally, it's a little bit of a long-term duration. So 16 and 13. I know gave you long answer, but so that's the answer. Right answer. I think you most of you got it correct, even though it is a guess. Okay, next one. Major economic function performed by derivatives is you should not get this wrong actually. It's everything, right? We spoke about hedges, speculations, arbitrage, everything. Okay. Answer is D, guys. Yeah, keep participating, please. When trading government bond futures, which of the following quantity of the face value can be bought or sold? Say, I think when we discussed in the class, we discussed about the what is the lot size of a government bond, right? Yes, nice. No, 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 no. It's not. It's not actually, guys. You're all over the place. Answer is actually C. Why one? Okay, I'll explain. Primarily, government bonds, the quantity of the face value can be bought only in the lot size of 2 lakhs. Okay. So you can ideally buy, this is the whole concept. Most of the questions in interest rate derivatives come. Okay. The face value of government bond futures will be 2 lakhs. I will discuss that again, but I'm repeating that to keep it here. 2468. Sir, your guesses are all good today. What did I just say? It's in an increment of 2 lakhs. So 2, 4, 6, 8, and 10. Okay, guys. So this is a very, very important concept because we will do a couple of numericals just in a bit. All the numericals, are surround on this question only. Okay. So this is a very, very, very important part. The face of the government bond futures is 2 lakhs. Okay. Take a note if you want. So here answer is 10. Next. Price quotation for the
Hello,
government.
hello, hello.
Yeah, sir, go ahead, sir.
Yeah, sir, why 10 then if it is face value is 2?
Huh. Increments of 2, sir. Increments of 2
Acha.
lakhs, sir.
Okay.
So you can buy 2 lakhs, 4 lakhs, 6 lakhs, 8 lakhs, 10 lakhs, 12 lakhs,
Okay.
15 lakhs, 16 lakhs, 18 lakhs. Rest of the answers are all odd. Okay. So primarily,
Oh, fine, fine.
if anything is even, that is going to be your answer. Okay,
So
sir?
multiples of 2. Okay.
Correct. Multiples of correct. Got it.
Thanks.
Okay. Price quotation for government bond futures. Yeah, today most of you are getting it wrong. I know. Don't worry. This is why like we are doing the session. Price quotation for government bond futures is always price per 100 face value. Okay. The answer is A. No, 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 no. Stop, stop, stop. The price per 100 face value. The answer is A. Okay. Just remember that. Okay. Now I want you to attempt this. Assuming the price of the government 10-year bond is 113, what is the market value of one contract? Attempt this. ये कैसे होता है? Yeah. Only Vijay sir got it correct. Answer is D. Just now I mentioned, what is the face value of the government bond future? It is actually in the multiples of 2 lakhs, right? So the market value of one contract for you is 113 times. Actually, sorry, the answer is, it will be 113 times 2 lakhs. It will be 2,26,000. That is your answer. Correct. Okay, guys, there are certain concepts in options and futures and forwards. See, yesterday all the questions revolved around forward mein kya hota hai, future mein kya hota hai, standardization and all that. We have seen that and we have done multiple questions on those lines, right? Similarly, in interest rate derivatives, most of the questions will revolve around, the face value, the contract of government bond future, which is 2 lakhs. 2 lakhs has to be remembered here, okay? So 113 times 2 lakhs will be your, the value of the contract. Everyone got it? Clear on this concept? Don't get it wrong. Next time we have a bunch of questions
Sir,
coming.
I have doubts.
Kiran sir, it would be B now, sir.
Oh yeah, sorry. I think
B the answer.
B. Yeah.
2 lakhs into 113.
Yes. Yeah. Okay. Yeah. Next one. Okay. What is the basis for final price at which the Treasury future bill contract is settled? Yeah. Most of you got it correct. Treasury bills, generally what happens is, there is an auction price of the treasury bill. So it is actually settled based on the auction price of the treasury bill. Okay, so the answer is A. Most of you got it correct. Nothing to do with FEDI, whatever FIMMD or whatever stuff. Okay, and there is nothing to do with the daily settlement price. The answer is A. Okay, guys. Okay, next. Yeah, now do this, please. The answer here is B. It's the same thing. Okay. You can practice that later, but yeah, the answer is B. Let's do this with a bunch of questions. Okay.
I
Which
think
of the following?
Sir, Kiran sir, just get back to the previous question, sir. Here it is similar to the earlier problem what we have solved now, sir. 113 into 2 lakhs. Here, can you just calculate it and see, sir, whether it matches the answer?
Just 1 second.
111.75 multiplied by 2
How much
lakhs.
has it come to?
So it is 2,23,50,000. So there is no answer here.
Yes.
Okay. Let me double check on that just a moment.
Either if
I know it has
if
to be
here B is
multiplied.
correct over there, that is wrong.
Yeah. Okay. Just let me check, while we go through other questions in a bit, just on this, question number 7. One second long. But let's go through the next one, while we keep talking. You're able to see my screen, right? You're able to see my screen, right? Hello?
Yes, it is visible.
Yes.
Okay, yeah. Yeah, go through this. Which of the following months is included in 3 serial quarterly contracts for the expiry of interest rate derivatives? See, interest rate derivatives are generally, we have quarterly contracts. So even without having any knowledge, I think we should be able to even answer this question. Which one, sir? Quickly. The answer is B, right? End of the quarter. See, is the Jan the start of the Jan is start of the quarter, May is start of the quarter, October is start of the quarter. See, that's what I'm telling you, right? Even if you don't know, sometimes, just try to eliminate, right? So here, what is the odd thing? It's the September. But primarily what happens is, the included 3 serial monthly contracts is actually end of the quarter. Okay. So March, May, June, July. Sorry, my bad. May, June, July. Yeah. And then, okay, what where did I get that from? Okay. First of all, why July, right?
March.
Not correcting me. March,
March,
June,
June,
September,
September,
December.
December.
Yes. Got it? Yeah. Next one. Okay. Why the okay, this is crazy. Okay. Keep attempting that and I'll give you an answer. Contract value when an investor purchases 10 lots of single bond futures at 99. Okay. Before that, remind me, how many of you remember what is the tick size in, futures? What is the tick size in interest rate derivatives that we discussed? Anyone remember? 0.0025. Yes. Start using that as well. Yeah, calculate the answer there. Anyone were able to calculate? It's easy, no? Okay, guys, one small modification. So the government contract, whenever you're doing there are two things here. Please just understand here a little bit. Sorry for the confusion before. The face value of the government bond can be purchased in the lot sizes of 2 lakhs. Okay, purchase can be only in the lot size of 2 lakhs. But what are we doing here? We are trying to find the contract value. In the contract value, what is our formula? The lot size times the price, right? That is our standard formula. The lot size for government bonds is 2000. That is why, going back to this question, there is an answer here. The answer actually is this one. 2000 times 111.75. Okay. In this also, sorry about that. We have to correct it whenever we do the mistake. So in the case of, again, 10-year government bond future, it's 113 times 2000, not 2 lakhs. It can be purchased, there are two different things. The face value can be purchased in the lot sizes of 2 lakhs, but the contract value of government bond future is 2000 for us. Okay. Whenever you do the calculation, keep that in mind. So similarly, the same thing, clear guys? Now, don't get confused. The lot size is always 2000. Okay. Now here, what are we trying to do? 10 times 99 times 2000 is the value. So I think it will come close to 19,80,000 or something. Okay. I don't know why it came through, but yeah. Next. Everyone got this one clear here? What is the contract value? See, this is what we have done multiple times in equity also, right? I've shown you Reliance and I've shown you multiple examples. What is always the contract value? The lot size times what is the futures price that is available there. Okay, it's as simple as that. Here also they're asking what is the contract value and what are they saying here? They're buying 10 lots times what is the price here? 99. Okay, but he did not give you what is the contract size. The contract size for government bonds is 2000. So the calculation will be 2000 times 10 times 99. Same concept here. It is just that you have to remember the contract, sorry. Yeah. The lot size of the government bond, which is 2000. Everyone clear here? I don't want you to miss this question. It's a very, very important thing. All the questions on interest rate will revolve around this only. Okay. Clear, guys? Everyone? Can we move on? Okay, perfect. Make a note of that. Yeah. Next one. So many questions to do today, you know. For long-term interest rate speculation or hedging with a long-term outlook, which instrument should be used? Which one? Most of you actually got it correct. It's 10-year government bond futures. Okay. Why are we talking about that? See, don't get confused. Guys. Again, don't get confused. You know, some of you have put in C. Okay. Very simple. Now tell me the first word itself, he's saying long term, right? What is the duration of T-bills? T-bills are only 91 days. There itself, the A gets eliminated completely. When A gets eliminated, C gets eliminated, and obviously D gets eliminated. So as simple as that, right? You know, you don't, sometimes what you have to do is you just have to use our brain and start eliminating. So long-term speculation or hedging is always 10-year government bond futures. Okay, guys? Okay, quickly. Next one. Which is the following is interest rate derivative? It should be all easy. Sorry. Yeah. Quickly, guys. Quickly. I think this should be easy. D. Why B, sir? Everything. Interest rate swaps, futures, forward rate agreement, everything is, you know, that's what I told you. Whenever NISM gives all of the above, most of the time, I mean, don't go blindly with that, but most of the times the answer will be all of the above. Okay. So in this case, it's all of the above. Next. Everyone following me, right? Please stop me, you know, we're more than happy to repeat and revise the topics. See, this should be your final sort of a revision for the exam itself, you know. Next one. Which of the following is interest rate derivative? Sorry, we have done this, right? Yeah, next one. For cash settled bond future contract that is currently being traded, what is the last trading day? Please be mindful. I think there was a little bit of a confusion. For a cash settled bond future contract, the answer is last Thursday of expiry month. Okay. So most of you got it correct, but some of you got it wrong. It is always last Thursday of expiry month. Okay. My bad. Sorry. Okay. Here is the next one is the tick question. Okay. Now solve this. For every 100 ticks, the price of the government bond future contract moves. The contract value changes by how much? Do the calculation a little bit, you know, little bit aram se. Very good. Someone got it correct. You know, D is the answer. Okay. Why? Very quickly. What is the tick? This thing for us 0.0025. Let me do this here. So it is 0.0025. You know, first of all, what you have to do is, first of all, you know, there is a 100 tick movement, right? So 0.0025 into 100. How much is that?
0.25.
0.25, right? 0.25 times what is our contract size? Yeah, lot size there. Lot size is always 2000, right? 2000 times 2.5, which is 500. Got it, guys? What I'm trying to say there is everything revolves around those same concepts only. 2000 tick price 0.0025. That's it. Okay. These are all very easy questions, not at all complicated. Everyone got this? 0.0025 times 100 ticks, it has moved 0.25 times. The contract, size is 2000, which is standard. So the answer is 500. Okay. Stop me if you have any questions, please. Next one. This should be super easy for you guys. Quickly. We should not even spend time on this. Come on, come on. Array. C. B का को सर. C. 58 को परचेज किया था, 56 को बेच दिया, लॉन्ग कॉन्ट्रैक्ट. सो सिंपल थिंग, ही इज इन अ लॉस ऑफ 2 rupees. Next. Settlement method for 91 day, no bill futures. What is the settlement, for the 91 day, bill futures? It's always only cash. There is nothing like physical thing. Okay. It's always cash. So the answer is B. Okay. Next one. Which of the following is the last trading day for cash settled 10-year bond futures? See, these are little things that you have to remember, unfortunately, right? It's not tricky, but these are some little things that you have to remember. You have to double check on this, but I think most of you have got it, 2 business days before the last day of the expiry month. But it's actually, the last Thursday of contract month. Okay. We'll come back to 16 and I'll actually share you the, the snippet again one more time. Let's move on to the next one. Okay. Cash or derivatives with underlying a theoretical bond and not a physical bond. It's very easy, right? They are called notional bonds. No, we know the concepts from long ago. Okay. Contract amount or market lock for government bond futures is, 10 lakh of face value. Stay true or false? It's false, right? The contract face value is what? 2 lakhs. Okay. Next. Treasury, bills and government bonds is respectively. No. So these are little things that you have to, this one. Both, actually are of the face value. Some of you have got it correct. Both treasury and government, are of the rupees of the face value for both. Okay. Yes, D. Got it. Perfect. Next. Below mentioned 4 values which can be bought or sold for government bond futures. Again, the same question. That A may bol raha that it revolves around certain concepts. That's why we are revising these concepts again and again and again. C. You should not get this wrong now after doing this and after learning the concept. The answer is C. 2, 4, 6, 8. Okay, we discussed that. Next. Person goes short in futures contract at 100 and expiry underlying price is 101. What will you do? It's typical thing here. Thing we need not even spend time. Quickly answer though. Make a loss of 1. Good. Participant buy 20 lot of single bond futures at 97. Contract value. Yeah, you can calculate. The answer is what? 20 times 97 times, 2000. Next, price of a derivative is basically determined. This is a very, very important question, that you will most probably will get. What is the price of the derivative? Very good. Nice. Price of the derivative is basically determined by underlying. Okay. Don't get carried away exchange. Exchanges never defines that. Exchanges does everything standardization except the price discovery mechanism. Okay. There's nothing like demand and supply of the derivative. It's basically determined by the underlying. Okay. Next. Underlying for interest rate futures is obviously currency. No, sir. Currency कैसे आया? Abdul sir. Interest rate futures is the only bond. That's it. Blind answer. Interest rate. Are underlying for interest rate futures is not interest. Okay. Guys, okay. What is he saying? Even though it is called interest rate futures, you are not trading the interest rate directly. Okay. First, listen to this concept, right? Even though the concept is interest rate futures, you are not trading the interest rate directly. Okay. What is the underlying asset? It is a bond. It is a debt instrument. Okay. That is an actual underlying asset. And when the price changes, so primarily what is happening in the case of the equity, we have traded Reliance and all, right? So similarly, interest rate derivatives में क्या trade होता है? Bonds trade होता है, right? The underlying is bond. The change in the price of that bond is where this whole asset class has come up, right? I think I mentioned that last time also. I'll quickly give you a little bit of thing, right? What exactly has happened with G6 in the last 1 year? When the RBI started, decreasing the interest rates, this was in 2025, G6 are supposed to go up, right? That is an inverse proportion generally. But instead of G6, what is the G6? What is a G6? It's a bond for us, right? 10-year government security bond. Instead of going, up, they started coming down from 7.4 to 6.2. That's why if you have invested, the DSP fixed income or any fixed income products did not actually make money last year. Okay, only the short-term instruments made money. The long-term instruments, none of them made money because the GSEC has fallen from 7.4 to 6.2. Now it slowly started climbing. It has come to 6.8. Okay, the concept here is, what are we trading there? We are trading the G6 there, or the T-bills there. What are they? They're actually bonds. Okay, guys. Sorry, I gave you long answer so that you remember that and not get this wrong anytime. Next. Okay, next one. Dash is traded in OTC in exchange markets. Ray, why are you getting it? Oh, no. Only one Nivesh sir got it correct. Yeah. Vadiraja sir, is it a fluke? You got it. Sir, don't get confused. Most of you got confused. Let me repeat this, right? See, most of you got it, put it C. The answer is ideally C. Forwards are actually traded in OTC market. Okay. Ideally, the answer should be C. But what is the question there? It is traded both in OTC and exchange markets. Okay. So, does forward trade on exchange markets? No, right? It traded only on OTC. So, it's little bit of, I won't say tricky, but it is little tricky because they want you to pick up C. The actual answer is none of the above. Got it? See, forwards traders on OTC, swaps and futures trades on exchange markets, but none of that trade both on OTC and exchange markets. Okay. So the answer there is, sir, what is this? I hope you should have given the exam today. Anyway, so the answer is D, guys. Okay, none of the above. Got the explanation, right? Okay, perfect. Now, next one. What is the meaning of market risk? What is called market risk? Market risk is called systematic risk, right? Sorry. I don't think it's not called risk. Yeah. Very good. Most of you got it correct, right? It is risk due to uncertainty of future profit or loss to price changes. Okay, straightforward. No explanation is required there. Okay. What is the underlying for cash settled six-year bond futures as per the current regulations? Everyone following me, please stop me anytime. Okay, if you want any explanation on the thing. The answer actually is B, right? So always see that, so under the current regulations, the cash settled interest rate futures, especially in India, which are like, 6-year G6, etc., and all government bonds are purely there is notional underlying. Okay. So let's not get into the specifics, but just remember it's notional. Okay. Okay. Give it an attempt. I will explain this. This is more of a what I meant to say theory answer though, but yeah. Limit of net long position of FPIs collectively can transact at interest rate futures. Okay, I'll answer this. The actually answer is C, 50 billion. They can actually trade up to 50 billion in interest rate futures, FPIs. Just remember this. Okay, next one. Now, how is the closing price for cash settled GOA bond futures contract determined for a trading day? It's based on okay. This question is actually standard across all the derivatives, etc. and all. We discussed this also, but I'll repeat this topic here. See, what is the closing price? What did we discuss? There is a difference between a spot price and a futures price, right? But the futures price, what happens is, I can actually close off the contract even on the particular day. So the close of the future, enlarge the font size. You can't see this. I will try. Can't see the answer. You can't see the answers? The answer is A
Sir,
though,
we
but
can see.
okay. Font is too small. Okay, let me see.
Sir, we can zoom, sir.
Font size is
No,
very
you
small.
We can zoom. Individual can
Select
zoom,
the
sir.
maximize button.
Yeah, it seems individuals can zoom. Please try it at your end. Yeah. Okay. Anyway, going back to the concept, right? So every day the futures price is closed. The last price of the future contract is determined by the weighted average transactions in the last 30 minutes. Okay. The answer is A. Please remember this. There is a very important thing. This same thing happens in equity as well. Okay. Last 30 minutes, not 1 hour or 1.5 hour. Okay. Next one. Okay, permissible movement of overnight MIBOR futures is of the base rate. How much? We will go through this. What is MIBOR? MIBOR is Mumbai Interbank Offered Rate.
Answer is D, sir.
not actually D. Okay, what did happen here? Okay, so here the answer got cut. Wait, hold on. Actually, no, guys, wait, hold on. I think the answer got cut here. The answer here is plus or minus 5%. No, so A got it wrong and I have to fix it. My bad. Permissible price movement for MIBOR is always plus or minus 5%. Okay, so that should have been under A, but sorry, my bad. Just remember that.
Sir, one request. Can you go back to that 50 billion question, sir? Can you repeat that slide?
This one.
28, sir.
Yeah, this
50
one. Sir.
billion.
Hmm.
That is 26 of that 78. 50 billion is the answer.
Yeah, 50, sir. Yes.
Which of the IRF port foreign? Okay.
FPA's
Foreign
IRF, 50 billion. Sir, don't worry. I will share this. You can go through that. Let's try to aim to complete that.
Okay.
We have only 15 minutes. I know it's a Sunday evening. I don't want to take your time. It's a family time.
Yes, sir.
Okay, 30. Next one, 31. Or base rate of MIBOR. Okay. Why did I say this one here? This is another concept which, most of your also questions do come from. What did we say? The permissible price movement of MIBOR futures is plus or minus 5%. Okay. Based on that is the next question here. Okay. Now solve for this. Very good. Got it. Plus or minus 5%. Most of you got it correct. It is actually either 5.25 or 4.75. Okay. Everyone got it? Why? See, simple MIBOR futures is 5, sir. I said 5%. 5% of 5 is how much? 0.25. Right? So 5 plus 0.25, 5 minus 0.25. 5.25, 4.75. Okay. You have to first calculate the value on the number given. 5 times 5%. Okay. Perfect.
No question. No. Answer B. Answer B.
Answer is C.
C. Oh, sorry.
Next one. Click. Last trading day and expiry day are one and same for the interest rate futures contract. The actually answer is true. Okay. Next. Inter-commodity spread consists of two trades with what is the answer? Okay, I'll explain this. The word itself again go back. The word itself. So actually the answer is none. Okay, let me explain the concept here a little bit. They are saying about inter-commodity. Okay, that means we are dealing with two different commodities. Okay, so consider you are actually buying T-bills and you are actually buying might be 10-year. Okay, G-Secs. So what does inter-commodity stands for? It is actually buying futures of one underlying. In this case, say for example, if you are buying T91 futures and then selling futures on another. Okay, so suppose you are selling futures at 10-year G6. That means two commodities that you are actually trading, but same expiry and same quantity. Okay, please make a note of this. I'm repeating that again. Intercommodity means you are actually picking up two instruments. In this case, say imagine you are buying futures of T-bills and you are selling the futures of G-sets. Okay, but the most important part is if you are buying 10 lots of T-bills, you have to sell 10 lots of G-sets, but on the same expiry month. Okay, so the answer is none of the above. Everyone got this concept? Intercommodity. Okay, so the answer should ideally be different underlying, but same expiry and same quantity. That should have been the answer. Okay, perfect. Because even if this is not there, like you should just remember that. Next, delivery margin is also collected on the yes. Abdul sir got it correct. Margin is collected on the day of intent. What is day of intent? Day of intent is the last trading day. Okay. After the intention to deliver and allocations are completed, the delivery margin is collected. Okay. So the answer is yes. Just remember that. Don't put too much of brain into this. Okay. Next. Which of the following is true with respect to regulations on buying of selling of T-bill and T-bond futures for non-resident and foreign institutional investors? You can even guess this. No. Don't say D as per my rule. Come on. I said D when it is all of the above, not none of the above. Come on. Come on, man. Come on. Navya ma'am got it correct. Actually, some of you are getting it correct. Ideally, the government will never allow them to short sell. If they start short selling, right, especially the bonds there, it is little tricky, So short positions are generally used for hedging only for them. Okay. They can't actually do naked, shorts, primarily. Okay. Whenever it is the case that, think through what the government thinks, you have to put yourself in the shoe of the government and if I am RBI, will I allow the, what I mean to say, FPIs and FIS to sell? Absolutely not. Okay. So they cannot short sell. Answer is C. Okay. Okay, we have some more time. Okay. Maturity of underlying bond on which the futures contract is currently listed is very good. Standard. It's 10 years. Okay. It's 10 years, guys. Most of you got it correct. Next. Currently, the underlying for interest rate derivatives in India are both. It's actually government bonds and T-bills. Okay. Both same, both 1 and 2. Okay. Got it. Trader expects the interest rates to go down in the near future. To profit, what should he do? And just to explain the concept, what exactly has happened. And this also. We have done this multiple times, even in MF exam also. Array. What is the relationship between bond futures and interest rate, guys? It's inverse relationship. मैंने अभी तो बोला ना, right? When the interest rate goes down, the government bonds are supposed to go up, but it behaved in a different way, in 2025. So always remember interest rates and bond, they both, operate in an inverse relationship. So if he is expecting the interest rates to go down, to profit, he has to, buy the bond futures, okay? Not sell. Everyone got the concept? It's inverse relationship. Next, exchange traded derivatives was first started in which of the following? It's easy, huh? See the option there, Infosys equity share. Equity index. Yeah? Nice. Let's quickly go through. Let's see if we can do another 10, 15. Contract month, expiry months for treasury bills in India are? Yeah. Lovely. The answer is C, right? 3 serial months and 3 quarterly months. Both mein ho jayega. Okay. That's what we've done that September ke thing. Okay. So both months and quarterly, serial and quarterly. Okay. Most of you got it correct. Answer is C. Next one.
Okay, but so how about that serial? So can you just explain, sir?
No, that's what we discussed. No, at the see what happens.
Quarterly, okay.
No. Hold on. See, what did we learn, sir? Basically, the contract expiry months generally, what happens with the T-bills is, let's go back to the equities, right? What are the expiry months available for us in equity?
Three things, sir. That near,
Months.
next, and far. Yes.
Yeah. 3 months, right? Rightness, sir. Okay. In T-bills, what happens is, the expiry is available for 3 months. And also the expiries are also available for, at the end of the quarter also. So end of the March, end of June, end of September, end of December also, there is an, expiry that happens, which means like, either you are playing the monthly expiry or you are playing the quarterly expiry. So T-bills
Okay.
have these 2 options. So the answer is both serial and quarterly. Okay. Unlike the equity, which is only month, T-bill also has a quarterly expiry as well. I think we should get it now. Okay, sir?
Thank you, sir. Thank you.
Perfect. Lovely. Okay, let's quickly move on. Okay. Yeah. Quickly. Should not get it wrong. Arey, ma'am. अभी तो सीखा था ना क्या सीखा था price of derivatives is determined by the underlying, that's it, not demand and supply factors. Okay, it's false. Next, when you are speculating the timing of a change in interest yield, you should match the what? No. Hold on. Guys, we don't have anything to do with the tenor. Okay. So what we have to do is, see, let me explain this concept here, right? So for example, what is he saying? If we are expecting the rate change to occur in 1 month, okay, what is he saying? Change in the interest yield, and the timings. For example, if we feel that RBI is going to increase the interest rates next month, hypothetical, right? So what should we ideally do? We should actually choose a contract which expires in the next month only, right? We are least concerned about the tenor of the underlying. What is tenor of the underlying? Whether, it is 91 days, 6-year bond, 10-year bond, etc. and all, right? We are not interested in that. Okay. We are interested in if it is, the question is asking, what is your decision making, in choosing a contract when the interest rates are going to change. So my interest will be choosing the contract which is available next to me, right? Not, at the longer period of time. And I don't care about the tenor, because whether it is T91, whether it is 6, 10, 15, whatever, not 15, right? 6, 10, I don't care. You got it right? So the answer is expiry date of the futures. Everyone clear on this concept? It's not none of their person. Most of you have got it C, but not C. It's expiry date of the futures. You got the concept here? Everyone clear on this?
Sir, generally, when interest rates are likely to change, it is said that you buy long duration bonds
Hmm.
so that you benefit from it.
Hmm.
So it will be the tenor, no?
That will benefit only when there is a fall in interest rates, sir, not
Exactly.
both the direction.
But change, yeah, exactly. So change.
No, sir. No, I
suppose
will
if
answer
the
this.
interest rate is to
Sir, Vijay sir, I'll
rise.
answer this. I think what Vignesh ji told is 100% correct, right? See, we don't know what the when will your decision come into the picture, what to buy, what to buy, and what not to buy. See, recently what happened with fixed income, all the short-term instruments went really high, right? If you see money market instruments have made humongous amount of money. Okay, but to your point of, we will take the decision only after the decision on the interest rate have come into the picture, right? How do you anticipate and take a decision, before even the decision comes? You're getting my point. That's what Vignesh sir is trying to say. Okay, what is saying is
Okay.
only RBI comes and says, I'm doing XYZ. Okay, based on that, you will pick up there your tenor will come into the picture. Whether I am buying a short-term instrument, whether buying a long-term instrument, what is the implication? All that come into the picture. But this is what he is asking. Even before that, whether what is going to happen, how my decision is going to impact based on the anticipation of the interest rate futures. Okay. Based on the anticipation, I will actually go only with the expiry date of the futures. Now we got it. If he says, I have already changed XYZ, how is your decision making going to change? Which one are you going to pick up? Then your answer will be C, basically. Everyone got it? Everyone got the concept clear?
Okay. Thank you.
What is the answer, sir?
Answer is yes, sir.
Thank you.
Okay. Perfect. Let's do at least until 50. You have 5 more minutes, right? We'll close. Yeah. Okay. We'll do until 50 and we'll wrap up the session. Okay. Yeah. 91-day treasury bill future is determined using
The underlying rise among
actually the answer is C. Ma'am got it correct. So what is 91-day treasury bill? Basically, let's not get into too deep into the details. I'll quickly explain. They follow this concept of cash and carry model, right? Which means what is the underlying price of the T-bill? Okay. And then the carry cost. Okay. Which is essentially what, your forward and, future financing cost. So the underlying price along with cost of carry and the forward rate. So the answer is C. Let's not put too much into this, but just remember this. That's more than.
So one question here. So the treasury bills it's going to be played on the bonds, right? It's going to 91-day bonds, right? 91-day bills.
Yeah.
Okay. So then it's going to be underlying assets. It could be that one plus cost of carry, right?
Correct.
Okay.
And the forward rate, yes. T-bills, mostly the popular T-bills are T91. What is T91? It expires in 3 months.
91 days.
Yes. Yeah. Which are the following sources underlying for money market interest rate futures available? It's more of a theory question. Try, Vadiraj sir, I think your guesses are getting correct today. Give it a try. Guys, attempt, there is nothing like wrong or right. Oh my god. अरे आज तो आपका luck बहुत है यार. You should have really given the exam today. The answer is B. It's Fibble and Mibor actually. Yes. Got it. Bingo. Nice. Lovely. And just remember this concept to understand here. Okay. How are future bond prices calculated? We'll just do until 50 and we'll wrap up the session, guys. Again, fluke.
Yes, sir. Again, yes.
अरे आज तो आपका नसीब तो it's like somewhere. Guys, the answer is D. Okay, cash price plus financing cost. No, not A. Accrued interest, not accrued interest. Come on. Okay. So there is cash price plus financing cost minus income on cash position. So what did we
Income on
say?
cash position is
Yeah.
we are
Cost of
getting
carry
that-
model. Yeah, we are paying the coupon, right?
and we're getting that interest every whatever maybe that tenure. So that
Yeah,
is
they
what
have to pay the coupon interest, right? That is income on cash position.
Okay.
Okay.
So that is
Yeah.
going to be discounted in the price, right? All this is going to be discounted in the price.
Yes. Okay, let's quickly go through. I know I'm taking a lot of time. Okay. Purpose of expiry of cash settlement, GOA, bond futures for 3 quarterly months. We have done this n number of times today. You should not get it wrong.
Experience Monster. Bluetooth mode.
What is the answer? We have done this n number of times today. I know. People will put C. I know people will put C. It's not C. Guys, check that one more time. Ma'am got it correct. D. Good. मैंने क्या बोला सर? March. I repeated multiple times, right? March, June, September, December. कुछ भी नहीं है. वो start of the month दिया था. Jan, Feb, March. Okay. April, May, June. No, it's the end of the quarter. Okay. Yeah, March, June, September, December. So the answer is D. After doing this, you should not get it wrong. I don't know why you're getting it wrong. Please remember that. That's it. Okay. Last 3 questions. Specified face value for one lot of treasury bill futures that can be traded. Answer is 2 lakhs. Standard 2 lakhs. Next. Purpose of determine the expiry of cash settled Government of India bond future contract. Which of the following constitutes a 3 quarterly month? Again, same thing. आपको समझ आ रहा है ना? Like how the questions will be. C. Got it? You should not get it wrong. Okay. We'll do this and we'll close the session for today. What basis are treasury bill future contracts quoted? I'll give you a hint. They're actually quoted based on the discount, yield method. Yes, it's actually 100 minus discount yield, not 100 plus. Okay, it's actually 100 minus discount yield. So treasury bills use actually this methodology of they're quoted using the discount yield method. Okay, everyone. Cool. I think we can close the session today. I hope you like the things. I think there are only 25 more questions. That should be easy. What I will do is, as I promised, I'll upload the thing and the answers. You can practice that. And yeah, any questions on today?
Sir, yesterday's was not uploaded, sir.
Yeah, I will upload it, sir, and it is ready.
Yes, sir, because
Sorry,
I missed your